Okay, so this is class 3, I think, of the 8 classes. So this class and the next class will be for FAC, and then the remaining 4 will be for MAC. So we'll do the financial instruments question from the exam paper that we have been covering. And what I want you to, what I wanted to say is that when you study, I hope you should not study where you are solely focused on the particular question that we're covering in the, you should not be focusing solely on answering the particular question. You obviously have to answer the particular question, but you need to go beyond that and try to identify what are the principles that they are testing. So that is the most important part, to identify what are the principles that they are testing. Because remember, what we don't know is what will be tested in the exam. What we also don't know is how it will be tested in the exam. And that is why if you work through a few questions, like I always recommend like about 5 questions, because when you work through 5 questions, that is where then you can work through it properly, as opposed to running through 100 questions. I'm not saying limit it to 5. I'm saying try to get to at least 5, but working through it really, really properly. So when I say that you must work, you must not just focus purely on the actual question you're being asked. You obviously have to answer the actual question you're being asked. But what you need to sit back and think about is the principles that are being tested and what you have actually been taught, okay, what you actually learned. For every topic, and every subject, literally, you must be able to do a few things. So if I think from an accounting perspective, you must be able to do journal entries, okay? You must be able to present an answer. So you must be able to present an answer in journal entries. You must be able to present an answer in terms of financial statements, that is income statement, balance sheet, equity statement, so forth, and the notes to the financial statements. You must be able to also discuss a question, and you must be able to do the calculations. Okay, so calculations filter into almost everything, but I also like to keep calculations as a separate thing, because sometimes the calculations can be quite challenging. So then you must be able to do calculations as well. So now you can't do this for every single thing, but as you work through a question, so for example, in this question, what we're going to cover is a discussion question. That very same scenario could have asked you to do journal entries. The very same scenario could ask you to show them what the balance would be in the balance sheet, or what would the interest be in the income statement, or whatever it is. So they can take the same scenario and they can ask you to do almost any question. So when you work through, you don't just want to focus on what they are asking you. After you've answered what they've asked, try to ask yourself, is there what else could they have asked, or how else should I be able to do this? So for example, here we can have a discussion question, but you must also be able to do journal entries. You must also be able to know how it would look in the balance sheet, income statement, equity statement, cash flow statement, notes to the financial statements. You must also be able to do calculations. Okay, so that's very, very important, because like I said, you don't know what they're going to ask. And so if you only focused on a particular question, you are training yourself only to answer that question. So when something new comes, you're not 100% certain. So that is why, as much as you want to work through different questions, which you should try your best, you must also work on developing a way of thinking. You must also work on identifying the principles that are being tested, because the way they can ask you for something, it's unknown, right? So, but they obviously have set a question around thinking about the principle. So in most cases, if not all the cases, the way a question paper gets set, they ask themselves the question, what do we want to test? Okay, there's like, okay, revenue. Then they ask, okay, what within revenue do we want to test? Okay, they'll say everything, or three out of the five steps, or whatever. Okay, or what would, and then they'll say the question around that, or they just happen to during the year or something, they happen to read an article, or they happen to stumble across something that when they see what's happening, a scenario or a story or something, they're like, oh, this will be a good exam question. And then they just go fetch that article or whatever, and then they'll set the exam question around that. But even when they do that, they'll still ask themselves, okay, what are the principles that a CTA student should know? And then how can we use this scenario to test those principles? So ultimately, no matter which way they go, it is coming down to the principles. All they're going to do is manufacture a scenario in such a manner that you probably wouldn't have seen the scenario before, and the way it may not be crystal clear what they are testing, but if you have trained your brain, trained yourself to identify a topic, and if you have trained yourself to identify the key issues and the key principles within each topic, then from there you should be able to handle almost any question. Okay, so it's very important that you don't limit yourself, and that is why it's difficult to work through 100 questions. It's difficult to get to 10 question papers, to 15 question papers, because the level of detail you need to go in. Because remember, if you go through 10 question papers, what's going to happen, you'd only be able to work through those 10 question papers as is. There wouldn't be time for you to sit back and think and ask yourself, what if it was a journal entries? What if it was a discussion? What if this? What if that? You wouldn't have the time for it, because the only time you have is to work through the actual question. That is why working through 5 is better, because you may only get through 5 questions, but you're asking you the various questions. You can't do 1 or 2 or 3. That's too little, because you need to get exposed to different types of scenarios and so forth. And each time you do a different scenario and you go in detail in analyzing a question and the principles, you learn new things. That is why the more you practice, the better. But also, it's not about the quantity only, it's about the quality of the practice. So please make sure you can you are aware of that. Okay, so I don't know how many past papers you have. Hopefully you have about 3 to 5, and you can work through 3 to 5 past papers, but make sure you spend real time in identifying the important stuff. And I'm not saying sit on a question paper forever, but do a little bit of deep thinking in terms of what else could they have asked. So for example, like like in this discussion question, you can ask yourself, okay, we're gonna do it now, but just to give you an idea. So we're gonna work through this financial instruments question. It's a discussion question, 20 marks. Okay. Now you could ask yourself after this, what if they ask me for the journal entries? Then what? Or keeping it to a discussion. This question had two things. What if it only had that amortization, amortized cost, and it has fair value through P&L? What would have made it fair value through OCI? Things like that you want to ask. So now you are training yourself of the various issues and the various principles, and so that when you get a scenario you haven't seen before, you need the ability to navigate a scenario. You need the ability to come into a situation where you are given something and you have absolutely no clue what it is, and you find a way to identify what it is and at least answer something. So that is part of the skill you need to learn. It is so a lot of us get frustrated when we come across something and we have no clue. Use that as an opportunity to actually develop the skill of navigating something you don't know, so that if it happens in the exam, you're able to do it. And even better than that, if it happens in the real world, you'll have a mechanism to actually navigate and find a solution. Okay, so it's very important because I'm reading through the scenario and the required and stuff. It's good level questions. So the exams is on high level. It's like a very good high level, good standard. So you need to make sure you up your thinking and your understanding of a topic to that level. Okay, so I'm going to now switch over into the scenario. Into the scenario. Um, Make sure you have the scenario and the required open so that we can read the required. So what I'm actually going to do, I'm going to read the required, and then we will work through the scenario. Then we will switch back to the scenario and we will work through it. Okay. Is there any question at this point while I switch over?
Not me, Faiz.
Nothing from my side, Faiz. Thanks.
Okay, so I'm going to switch. Okay, I got it open. I'm going to share my screen. Okay, so you should be able to see my screen. Okay, you should be able to see my screen. Discuss the accounting treatment of investments made by Gibela in note 4. Okay, investments. So we're going to look at note 4, investments. What you need to do, discuss the accounting treatment of investments. Okay. Okay, I'm going to get to the scenario now. What I'm doing here. So remember what we need to do, discuss the accounting treatment based on note 4. So, okay, let me just do that. Okay. So let me just see, what am I doing here? Okay. So what's important to understand, they say discuss the accounting treatment. Okay. So that means you need to identify the accounting standard, and then you need to then apply whatever needs to be done within that standard. If they said, dear student, please discuss the accounting treatment in terms of IFRS 9, meaning in terms of financial instruments, then there's no need for you to identify the accounting standard because they're telling you that's the accounting standard. In this scenario, they did not say the accounting standard. So we need to first identify which standard it applies to. Once we identify which standard it applies to, then we will then we use the standard to discuss the accounting treatment. So just make sure you pick up that subtle difference. Okay, so there will be marks available for for discussing which accounting standard. So for example, if you do not discuss which accounting standard, even if you get 100%, you won't get 100% because you're going to lose the marks allocated for identifying which standard it should be. Okay, so that's very important. So the question only said discuss the accounting treatment. It did not say discuss the accounting treatment in terms of IFRS 9. So what's the difference? Because it did not tell you which accounting standard, it means you need to identify which accounting standard. If they told you the accounting standard, then there's no need for you to identify the standard. Okay, very important. Now, from reading it, you must already know it's IFRS 9. So that means that's the first thing we will discuss the definition of IFRS 9 and then show them why this meets IFRS 9. Okay, so that's how when you want to discuss in terms of when you need to identify the accounting standard, you just basically just show how the item meets the definition of that standard. Okay, so we know it's IFRS 9. So what we do, we show them how it meets the definition of IFRS 9 financial instruments. Okay, so that's important. Once we now conclude that it's IFRS financial instruments, what we know within financial instruments is that there are three types of financial instruments, either financial asset or financial liability or equity. Then you'll need to tell them which one is it. Once we know that, now we discuss the accounting treatment, because remember in IFRS 9, it depends on what it is, whether it's an asset, a liability or equity, that will determine how we have to do the accounting treatment. Okay, so that's important to understand. If this was like investment property or in inventory or PPE, the moment it meets the definition, we can go straight into the accounting treatment because it's not another layer. But in financial instruments, once we say it's financial instruments, we then need to tell them what type of financial instrument, financial asset, financial liability, or financial or equity. Okay, so just be aware of that. So that's what we're going to do. So we're first going to discuss whether it is how it meets the definition of a financial instrument. Then we're going to discuss, because remember, we're making an investment. Okay, so therefore for us, it should be a financial asset. If this was the other side of the party, it would be a financial liability or it'd be equity, okay, depending. But for our purposes, because we're making the investment, we are the investor, we're the holder, we're not the issuer. If we were the issuer, we would be on the side of equity and liabilities. But because we are the holder, so that means we are the holder of the instrument, so therefore that makes it a financial asset. Okay, so we know that. So now we need to tell them. So once we show it meets the definition of a financial instrument, we also know that we on the asset side. So that means we have to show them how it meets the definition of a financial asset. So now once we have those two legs, now we discuss the accounting treatment of a financial asset. Okay, so that's very important. Remember, the accounting treatment of a financial asset, the first thing you have to identify is the type of financial asset. It's either amortized cost, fair value through OCI, or fair value through other comprehensive, or fair value through P&L. Okay, then you need to discuss initial recognition, and you need to discuss subsequent measurement. Okay, what you can, so that you interesting, so that is, you first try to identify the type of instrument it is. Financial, once you have financial asset, whether it is amortized cost, fair value through OCI, or fair value through P&L. Okay, so that is that's the high level thinking. So once we know the high level thinking, we understood the required. The required said, dear student, discuss the accounting treatment. It did not say discuss the accounting treatment in terms of IFRS 9. It said discuss the accounting treatment. It did not tell us which standard. So therefore, we identify the standard. Okay. So that's so like I'm just repeating myself, so you get you understand the thinking process. So the first part is to show which standard it meets. Okay, so we know it's a financial instrument, so we show them how it meets the definition of a financial instrument. That's step number one. Step number two, we will, because specifically for financial instruments, there are different types of financial instruments, right? A financial asset, a financial liability, financial asset, financial liability, and equity instrument. So we will need to show which instrument. Okay, so so that is basically what we will be doing. um, what did I say now? Yeah, so that is basically what we will be doing. So now we show them, so we know it's a financial asset. So that's what we will do. This show them how it meets the definition of a financial asset. Thereafter, what do we do? Thereafter, what do we do? What did I say now? Yeah, so thereafter, what do we do? We now discuss the accounting treatment. So for a financial asset, what do we know? There are different types of financial assets: amortized cost, fair value through OCI, fair value through P&L. So we first discuss which one. Once we know which one, then we discuss initial recognition, then we discuss subsequent measurement. Okay, so that is basically what we need to do. Remember, they told us to ignore presentation and disclosure, so there's no need to discuss presentation and disclosure. Okay, so are we happy with that? That's the thought process. So let's go and look at so let's go with this now, note number 4. I just want to get me a tissue quickly for my nose. For some odd reason, whenever I tutor, my nose becomes a problem. Okay, so that's note number 4. Okay. Okay, so note number 4 is quite short. Okay, so just quickly read note number 4 up until just before general information. So it's very short and we will discuss it. 20 marks for half a page. Okay, so you can imagine how much is going through here. So what I'm going to do, I will talk you through it, right? And then I'm not going to still type it out because the solution, I have everything well documented. Okay, so I'm gonna explain it to you, the thought process and what are the important stuff to put down. And then you can use this video to listen to it again and try to get to the answer if you're stuck with anything. Okay, just give me 2 minutes. I just need to get my, sort out my nose quickly. Okay, I'm back. So let's quickly just read through this, and then I'm going to take you through the thinking process and mention the important points you need to make mention of. You can then just listen to this video again if you want to. I'm not going to retype all the answers because the answers are in the solution, but I want to get you through to the thinking and what needs to be made mention of. Okay. So just to read this portion again, the Gibela often has excess cash reserves. As its software solution, customers pay part of the contract amount upfront. In a bid to manage idle cash resources, Gibela purchased the following instruments on 30th September 2019. Okay, so that's when they made the investment. So there's a $12,000 and then there's a $15,000. The $12,000 is preference shares in T, a company listed on the Johannesburg Stock Exchange. Okay. And then we have zero coupon debentures. So what you must know, when you invest into shares, it will most likely either be fair value through OCI or fair value through P&L. Okay. So remember, the thinking is as follows. When you have a financial asset, okay, so when you have a financial asset, so firstly, well, we will discuss now what makes it a financial instrument, and we'll discuss again what makes it a financial asset. Yeah, I'll come to that point now. But remember, when you see a financial asset, then there are three types of financial assets: amortized cost, fair value through OCI, fair value through P&L. What makes a financial asset at amortized cost or whatever, or the fair values, depends on the business model. Okay. Now remember, what is the business model test? The business model test is to determine whether a company is holding an asset to collect contractual cash flows. That's the first one. And the second, whether the contractual cash flows are solely payments of interest and principal. Okay, so remember, the interest payment represents two things. The interest payment represents two things. Number one, time value of money, and number two, credit risk. Okay, so when a company, when a bank offers you a rate, they look at your credit risk, okay, your credit profile. So if the interest rate is solely got to do with credit risk and time value of money, then it would that would make it cash flows of solely principal and interest. Okay, so that's important to take note. So only if it meets that condition, those two criteria, hold cash flows to collect contractual, hold an asset to collect contractual cash flows, and then number two, the contractual cash flows represents only payments of interest and principal. So it only represent that, then that means both criteria are met, and when both criteria are met, it will be amortized cost. If it does not meet those two, it can't be amortized cost. Then that means we are left with fair value through OCI and fair value through P&L. Now remember, something can only be fair value through OCI in two instances. Okay, number one, it's an investment in shares. So number one, it is an investment in shares, and the company have chosen to measure it in terms of fair value through OCI. Okay, so remember, if you have invested in shares, then you can choose to measure it at fair value through OCI. But once you choose it, you can't go back. So accounting refer to it as irrevocably elect. Okay, so if a company irrevocably elects to measure at fair value through OCI, they can, but they can never change their mind. Okay, so that is a choice for a company, and that is only when they have investment in shares. Then the second one is where the business model is to collect contractual cash flows and to sell the asset. Okay, so when the objective of the business model is to collect contractual cash flows and to sell, then it will be fair value through OCI. Okay, so it's very, very important. Um, so if it's not amortized cost, then it's either fair value through OCI or fair value through P&L. It can only be fair value through OCI in one of those two instances. One, where you choose to elect. The second, where you have to make it fair value through OCI. Which one do you have to make it fair value through OCI? When it's in a business model to collect contractual cash flows, but the second criteria is not met. The second criteria is the cash flows or interest, principal, and to sell the asset. Okay, so the cash flows is made up of three things: interest, principal, and the sale of the asset. So in that instance, it does not meet amortized cost because amortized cost does not include the sale of an asset. In where this one includes the sale of an asset. So in this instance, it can't be amortized cost. So it will be mandatorily measured in terms of fair value through OCI. So if we don't meet amortized and if we don't meet fair value through OCI, automatically it will be fair value through profit or loss. Okay, so just be aware of that. So if we look at this one over here, this here is, so here we can see preference shares. Okay, so there we can preference shares in a listed company. It says Gibela would be paid a dividend of 10% of face value annually. Okay. Okay, so we'll have a look at that now. Then we have zero coupons. So here they say Gibela would receive a bullet payment at the end of 5 years plus a premium. No other cash flows would flow to Gibela. Okay, so here you can see this one at this point in time most likely is, so this one is most likely amortized cost because it's a debt instrument. We're holding it to collect contractual cash flows. The contractual cash flows is purely payments of interest and principal. Okay, if you have a premium or discount, that's fine. So it includes premiums and discounts as well. Okay, this one over here is the payment over here is a dividend. Okay, a dividend is not based, the cash flow characteristic of dividend got nothing to do with credit risk, got nothing to do with time value of money. So as a result, this cash flow is not solely payments of, it does not meet the cash flow characteristic. So remember, what you must understand that for amortized cost, it must meet the two criteria. It is held in a business model to collect contractual cash flows. That's number one. And two, the contractual cash flows is solely payments of interest and principal. Okay. Now, the cash flow characteristic, what type of cash flows? So the cash flows, it must represent a credit risk or time value of money, right? So a dividend does not represent credit risk, does not represent time value of money. So therefore, it does not meet the cash flow characteristic test. Okay, so that's very important. So this one can't be amortized cost. It could either be fair value through OCI or fair value through profit or loss. Now, this one for fair value through OCI, it can't be the mandatory fair value through OCI. It can only be the voluntary one. What is the voluntary one? Where the company chooses to irrevocably elect fair value through OCI. So if they don't tell us, then it can't be. Okay, so then that means we know it can't be amortized cost. It could potentially be OCI if the company chooses. If they say nothing, then it can't be OCI, then that means it will be fair value through P&L. This one over here, it appears to look that it meets the amortized cost criteria. Okay, but we'll go through it now. Let's just read further. Okay, so we need to understand what is the policy of management. Okay, we can't guess it, they must tell us. So the same management identified that its policy for managing all its financial instruments was to collect contractual cash flows. So that is the management's policy to collect contractual cash flows. Okay, so their business model is to collect contractual cash flows. And then they say, and should Gibela face any cash constraints, they would liquidate the investments. That is totally fine. Okay, so remember, the contractual cash flows does not mean you can't ever sell it. If a need arises and you sell it, it's totally fine. However, the objective must not be to hold and sell. If selling is just merely as a result of some event, that's totally fine. But if your intention is to hold and sell, then you must take a look at that. So this one over here, they are saying, should they face cash flow, then they will sell. So that does not mean the business model is to collect and sell. It still means that the business model is solely to collect contractual cash flows. Okay, so just be aware of that. They say management is confident that they have adequate cash resources to fund working capital, and therefore it is unlikely that they will ever liquidate the investments. Management did not make any classification designations. Okay, so here you can see now. So for both instruments, we'll have to go through the business model test and the cash flow characteristic test. Okay, but let's start from the beginning. The beginning would be, let me just swipe that. The beginning would be okay, so the first thing we'll need to do is to discuss the which accounting standard. So the first thing would be to discuss which accounting standard. So we know it is financial instruments. So we must show it why it is financial instruments. So remember that, that for an item to be to fall within the standard of financial instruments, it must meet the definition of a financial instrument. So you will say a financial instrument, an item is a financial instrument where the one party has a right to a financial asset, and the other party has an obligation for a financial liability or an equity instrument. Okay, so what makes something a financial asset? What makes something a financial instrument? Where one party in the contract has a financial asset and the other party have a financial liability or equity instrument. So that's what you will start off with. Now you will need to show that the one party has a financial asset and then the other party have a financial liability or equity instrument. So then you can say, Gibela has a financial asset. Then you say, what makes it a financial asset? Remember, the definition of a financial asset is that you either going to receive cash or you're going to receive another financial asset or anything else. Okay, so you can read through the whole definition. Now I will say Gibela has a right to receive cash. The cash is the dividends, the interest, and the principal amounts. Okay, so they have a right to receive a cash, which is dividends, interest, and the principal amounts. Okay, so that shows it is a financial asset. And then you can show the other party, which is, I don't know who's the other party now. The other parties have a financial liability because they have an obligation to return, to pay cash. Okay, so they have an obligation to pay cash. So that shows that one party has a financial asset and the other party have a financial liability, and that shows that it meets the definition of a financial liability. We already said now, in that same thing, we already said that Gibela has a financial asset because they have a right to receive cash. Okay. Now we need to discuss the type of financial asset. Now I will tell them that a financial asset could either be classified as a financial asset measured at amortized cost, or a financial asset measured at fair value through OCI, or a financial asset measured at fair value through P&L. Okay, so you're telling them that is how a financial asset can be classified. Then you will tell them that classification is based on the business model. Okay, so you will tell them that the classification is based on the business model and how management manages the financial asset. Okay, so you tell them that. Now you will say the business model test is as follows. So now you will say we have to go through the business model test, and the business model test is in terms of whether they're holding the asset to me, whether they're managing assets in a business model to collect contractual cash flows. So in both instances, that's what they told us, that they are holding the assets to collect contractual cash flows. So we'll tell them both the preference shares and the debentures are held in a business model to collect contractual cash flows. So it meets point number 1. Now we must ask ourselves, point number 2, the contractual cash flows. So now we'll say, we now need to determine whether the contractual cash flows are solely payments of principal and interest. Okay, now I will say that for preference shares, the contractual cash flows is a dividend plus the principal amount. For the debentures, it is the interest, the coupon, plus the principal amount. So now, and then you will just tell them that although, so what you must also say that despite the fact that Gibela may sell the investments in an event of cash flow constraints, that does not impact the business model. Okay, so that's fine. So you just tell them that. That's like a 1 mark to tell them that. Okay, now you must say we need to go through the cash flow characteristic test. The cash flow characteristic test says that this would be a cash flow in terms of amortized cost if the cash flow is purely got to do with credit risk and time value of money. Okay, so you make that statement. Then you will tell them that the cash flow characteristic of the dividend does not represent a credit risk, and as a result, it does not meet criteria number 2. Therefore, the preference shares will not be classified as amortized cost. Okay, so why does it not be classified as amortized cost? The preference shares do meet criteria number 1, which is collecting, holding cash flow, holding the asset to collect contractual cash flows. However, it does not meet criteria number 2. Criteria number 2 is that the contractual cash flows are solely payments of interest and dividends. We are getting a principal amount. What did I say? Sorry, solely payments of interest and principal. We are getting a principal amount. We're not getting interest, we're getting a dividend. You must tell them that the dividend does not represent a cash flow as a result of credit risk. Okay, so therefore, criteria number 2 is not met for the preference shares. And as a result, the preference shares cannot be classified as a financial asset measured at amortized costs. Okay, so that's what you conclude. Now you must tell them, now you still have to go further to say, now what is it? So now you will say, so that means it could either be fair value through OCI or fair value through P&L. Now you tell them, in order for it to be fair value through OCI, one of 2 scenarios is possible. Number 1, the company, Gibela, elects to irrevocably classify the preference shares at fair value through OCI. You tell them they did not, so therefore it can't be that one. The second one is it is mandatorily classified at fair value through OCI. Now I must tell them when is it mandatorily when is it mandatory to be classified at fair value through OCI? It will only be mandatorily classified at fair value through OCI if the contractual cash flows was interest, principal, and the resale of the asset. That's not the case. So therefore you say it does not meet the mandatory one. As a result, it will be classified at fair value through profit or loss. Does anyone have any questions on that before we go on to the next one? So can I just give you guys 5 minutes, right, to discuss it amongst yourself, and then one of you report it to me? Is that fine? I'm going to give you 5 minutes to tell me how do we get to fair value through how do we get to classify the preference shares at fair value through P&L? Wait, what am I looking for? Okay, Desiree, Justin, Madeline, Nason, Shayla, Taurai, Dinashi, Walter. Can I give you guys 5 minutes to discuss it amongst yourself, to come to show how we ended up at classifying the preference shares at as a financial asset measured at fair value through profit or loss. So in order to get to that point, you need to first show why, in order to get to fair value through profit or loss, okay, you need to show why it is not amortized cost. So that means you need to first test for amortized cost. If it's not amortized cost, the way you can only show it that it's not amortized cost is by testing the business model. Okay. Once it's not amortized cost, you then need to test it for fair value through OCI. If it does not meet fair value through OCI, it will be fair value through P&L. Okay. The only time it can automatically be fair value through P&L if you are holding the assets for trading. So if you trade in the assets, automatically it's fair value through P&L. But if you're not holding for trading, you need to go through to show why it's not amortized cost, why it's not fair value through OCI, and then that means it comes to P&L. So it is now 25 past. I'm gonna give you guys, I'm not gonna be here. I'm gonna walk away so I can give you guys free discussion. And then I'm gonna come back at 30 and then one of you can explain it to me. Okay, are we happy with that? Just give me a thumbs up or say, would you just respond somehow? Desiree, Justin, Madeline. Shayla, Taurai, Walter.
Not advice.
Okay, so I'll come back at about 30 and then one of you can take me through it. Please discuss it amongst yourselves. So just to make sure that everybody's getting the thought process going. Once that is done, then we'll go on to then we will do the business, the one for the
Hi guys.
Hi, how are you?
Hello. Fine, I'm doing great. Let's discuss.
Okay, maybe someone can just explain like what was being said. If we are to consider at amortized cost, what are the elements that we need to look at? If someone could explain, and then we see if this one qualifies to be measured at amortized cost.
I can start maybe for the amortized costs. We say there are conditions that have to be met, that the asset is held within the business model, whose objective is to hold the financial asset in order to collect contractual cash flows. Then the contractual terms of the financial give rise on specified dates to cash flows that are solely payments of principal and interest. But you find with my preference shares and our preference says they are not holding such a model of having the principal payments and interest. Hence, we move to the financial assets measured at fair value through comprehensive income.
Okay.
I think someone can take us through the comprehensive income conditions.
Tao.
Sure, come through.
Yes, I don't want to discuss the one you said I should because I don't know how. But on the one that you were talking about, I think you might have left something in terms of the classification in determining the principal and interest. I thought Faiz had mentioned issues to do with time value for money. You were saying for us to be able to classify it under amortized cost, there is an element of time value for money that has to come through, especially on the cash flows. So once they fail to meet, like in the case of dividends, where they have failed, not just because it's not interest, but because it does not take into account the time value for money, is one of the conditions that we should consider. Just thinking.
I know it's one of the things, but remember, under the amortized cost, there are conditions that have to be met. For it, if they fail those two conditions, we move to the financial to measurement at fair value through comprehensive income. We test those conditions that are mentioned there.
Okay. So if I'm getting Webster right, are you saying that's the third one, Webster? The issue to do with time value of money.
No, I don't think it's the third one, but when it says solely payment of principal and interest, I think that's what it means, where they are taking into consideration the issue of time value of money.
Oh, right. Okay.
It has to be, because once interest takes into account the time value of money, I think that's where the issue is. I'm just thinking.
Because until remember, they are getting the preference shares, they are gonna get a dividend. Remember, dividend travel notaba are attached to any lending or borrowing interest, so there's no time value of money. I think how much the percentage? I think 5%.
10%.
10%. It's not linked to any lending rate or borrowing rate, so that you can say there's an element of time value of money. But I think for us now, when we're discussing it, we first need to fail it on those two. Amortized cost, we state the condition. The OCI, we felt that because OCI, there's an element of us selling the financial asset at the end. We are collecting the cash flows and selling the financial asset.
Yes.
But in our case, they are not selling the financial assets.
And also, I was saying there is an element of reinvesting.
I'm saying to like the business model holder is the one in which they have to collect cash flows and also selling that asset, that financial asset. For example, they are meant to be collecting cash flows, then they also sell those preference shares. But if you read in our scenario, there was no mention of us selling what? Preference shares. So hence it fails on meeting those two on the OCI element. Then we go to now the measured at fair value through profit and loss. Because if it's not measured on OCI or amortized cost, it now goes to what?
Through profit or loss.
To profit and loss.
Yeah, then
so that's where we are getting
right. Okay, that's why I don't know if I'm putting it correct. That's what I'm saying on fair value through OCI. we are saying there is an element of reinvesting the financial assets through collecting of contractual cash flows, right?
I wouldn't know the term reinvesting. Maybe that's what the one that is confusing me. But
Buying and selling.
okay, what they are saying is if you, the 1 year under OCI, and if you hold the financial asset, the motive is you get some cash flows. But eventually, what you will do is you sell that asset at the end. Then at the end, you no longer have an asset. Those are not the financial asset and the financial asset shall be measured at fair value through OCI if both of the following conditions are met. One condition is the financial asset is held within the business model whose objective is achieved by collecting cash flows and selling financial asset at the end. The contractual terms of the financial asset give rise to specified date to cash flows that are solely payments of principal and interest in the principal amount outstanding. So kapiwa interest next to all of interest on the balance. But at the end you say, let me sell this asset. That's the one pinda through OCI. But because our own preference shares, they are not gonna be sold. And remember, ana principal and interest it's coming as dividend, 10%. Isina maybe the one you're mentioning about time value of money. So at the end, that it fails there. And also we are not getting cash flows are principal and interest. Hence you failure on OCI. So you have to end up to P&L.
Okay, then I also think that we need to include the element of irrevocability, where it says an entity may make an irrevocable election at initial recognition for particular investments in equity instruments that would otherwise be measured at fair value through profit or loss to present subsequent changes in fair value in other comprehensive income. So I think somehow this one was being applied to the other comprehensive income business model, that if a company then does an election through other comprehensive income, they are then no longer allowed to change. And in our case, that statement was not stated, so it wouldn't lead us to measuring the financial asset at fair value through other comprehensive income.
That's correct.
Yeah, so I think that's the other one. So I think, yeah, at the end, it's all leading us to fair value through profit or loss.
That's correct.
So who is able to speak on behalf of everyone?
You guys, what's the verdict?
Hi, sorry guys, I'll go from the something. You know, so Siana Papine fair value through OCI because actually if you're holding a financial asset for trading, automatically it then becomes fair value through P&L. And then Kuno Kundrukunza also like through OCI, equity the financial asset by A. The financial asset is held within the business model whose objective is to achieve both collecting contractual cash flows and selling the financial asset. So isn't it could both include the trading, the financial asset?
I think the difference for me where I'm seeing it is it's such a time you're going to remember when you're on stock exchange, you can buy and sell there and there. But I guess on this one is you can hold it for maybe for some period. Then eventually you say, after I've gotten my interest in principal, then I can sell the asset at the end. It's like I think the timing, that's where the difference is. The other one you're like actively trading on a daily basis, you change, but that one you have to wait a bit of time, you get your interest or whatever, the cash flows. Then later on you say, I've managed to get my income, can I sell this one now? That's what I'm thinking.
Is there a mandatory fair value through OCI?
A mandatory one.
Mm.
Yeah, I think so. When you eventually, I think when you say after this period, I will resell this or I will sell the financial asset after I've collected some cash flows, then you say at the end, I've invested it's enough. Now I think I can take it out, I can dispose it off. That's the OCI one.
Yes,
When
you
if
have
you
to
look
make
at the
sure that,
conditions,
yeah, and you have to make sure the payments are comprising of principal and interest.
yeah.
Yeah.
Okay, so let's quickly go. Let's go through it. So who's going to take me through it?
Everyone is gonna participate, Vice.
Okay, so let's quickly
Yeah.
go.
Okay. We said in terms of the, we start with the classification of financial assets through measured. Okay, the financial assets shall be measured at amortized cost if the two conditions are met. One, the asset is held within the business model, whose objective is to hold the financial asset in order to collect the contractual cash flows. Then B, the contractual terms of the financial asset give rise on specified dates to cash flows that are solely payments of principal and interest. So
Yes.
in our case, the preference shares, we are not collecting cash flows payments in the solely in terms of the principal and interest. Therefore, it doesn't qualify under the amortized cost. Then we go to measured fair value through comprehensive income. I think someone can take over.
Okay.
There are two conditions, I think so, that have to be met there.
Okay, so let's hear.
Okay, I think on the,
Just tell me your name.
okay, I'm Nyson.
Nyson, okay.
Yes, so looking at the, when we're measuring a financial asset at fair value through other comprehensive income, we need to consider a business model whose objective is to achieve both collecting contractual cash flows and selling financial assets. And also the contractual terms of the financial asset should give rise on specified dates to cash flows that are solely payments of principal and interest. And looking at our financial instrument of preference shares here, there is no principal and interest component of us as we are getting the dividend. So it then disqualifies it from being measured at fair value through other comprehensive income. And also it has been said that the management is liquid enough to continue with the investment, meaning that they are not going to collect contractual cash flows and then sell the financial assets. So it will be a continuing thing. And also they did not mention any element of having an irrevocable election of measuring that financial asset through other comprehensive income. So it disqualifies it from being measured at fair value through other comprehensive income.
So automatically we're going to be fair value through OCI. I mean, fair value through P&L. Okay, so that's correct. Now, just make sure that, so obviously you spoke it through, so that's great. So just make sure that you can write it out, but in less words than you spoke. So in the word that you spoke, you're 100% correct, but it's easier to speak than to write. So just make sure we can write so that it's just like one sentence or two sentences per bullet point. Okay, so you don't want to write too much, because remember when you write too much, the examiner gets lost, then they give you less marks. So that is why it's important to practice to write. I don't know if you guys are writing or you're writing physical or you write online, but whatever you do, whichever one you're going to do, make sure you practice in that manner, okay? So you have it in your head, now is to practice how to put it down on paper in a very, in one line. So each bullet point, one line. Okay, but that is perfect. There was just one thing I wanted to make mention. Okay, yeah, okay, so that's fine.
So Faiz,
Yeah.
so in terms of, I think what I was also alluding to earlier on during the discussion, maybe it was something to do with equities, right? So I think if it is equities and you choose to value them through OCI, I think there was something I've come across something like that, right?
Mm-hmm.
For equity instruments, that it becomes voluntary or mandatory to measure through OCI. I
Not
think
mandatory. No, it's not mandatory. It's an
voluntary.
election. Voluntary, yes.
Oh, okay, okay.
Yeah. So that is the irrevocable election. Okay, so that's that one. Okay, so if you elect, if you elect for it, that is the voluntary one. Okay. You
Okay.
happy? You happy with that?
Yes, I'm happy with that.
Yeah.
So it is equities.
Yes.
Oh,
A share, equity share, yeah.
oh.
So that is that. Now for the debenture is going to meet the business model, you're holding it to collect contractual cash flows, and it also meets that the contractual cash flow is solely payments of principal and interest. Okay, so therefore it's going to be amortized costs. What's important to take note is that although there's a premium, that doesn't negate it from not being solely payments of principal and interest. It make mention that a premium is okay, or a discount, that's okay. So just be aware of that. So therefore, the debentures meets the amortized cost business model criteria. So therefore, the debentures will be at amortized cost. So the first thing we did was discuss that it was financial instruments. The second thing the first thing we did, we showed in terms of discussing it that it was a financial instrument. Then we showed it was a financial asset. Then we explained how we're classifying the financial assets. Okay. Now that we know the classification, now we can do initial recognition and subsequent measurement. So for initial recognition, remember, no matter which financial asset it is, you will always measure it at fair value. So for a financial asset, you'll always measure it at fair value. So when you deal with initial recognition, there are two parts. Initial recognition deals with when do you recognize. So when do we recognize? When we become a party to the contractual obligations, okay, or to the contractual conditions. So, or the word they use, the contractual provisions, okay, to provision the terms of the contract. So when do you recognize? It is the date when we become party to the provisions of the contract. The word provision just refers to the terms of the contract. So when was that? When we purchased it on the 30th of September 2019. Then at what amount do we measure it? So remember, initial recognition deals with two parts, when and how much. So at how much do we recognize it or measure it? At initial recognition, at fair value plus transaction costs. Okay, so we always measure it at fair value, not how much you pay for it, but rather fair value plus transaction costs. Remember, transaction costs you will add to the financial asset if it is measured, if it is classified at amortized cost or fair value through OCI. If it's measured, if it's classified at fair value through P&L, we expense the transaction costs. Okay, so just take note of that. Then at subsequent measurement with fair value through OCI, we simply do a fair value gain or loss, and the gain or loss goes through OCI. For debentures, what do? We apply the effective interest rate to work out interest, and the difference will go to go against the principal amount. Okay, so that's basically the answer. Is there any questions from your guys' side? You want to discuss some more things further on this issue?
Can we say classification through OCI? I think there was something that there is a term that I brought in there that you just need to see if it relates to measurement of the financial assets through OCI. Can you say you are reinvesting? Can you talk about reinvesting when you are measuring a financial asset through OCI?
What do you mean?
How you are getting the contractual cash flows? Is it something to do with buying, selling? How are you holding the financial asset? You buy it today and you sell it at the end of whatever time you feel you can sell, and you no longer have the financial asset, or you are, it's a process. How are these financial asset actually translating into cash flows through OCI?
Oh, you mean how do we get cash flows from a financial asset? What do you call it? So remember, it all depends on the financial asset. So if it's a debt instrument, you will make money through the interest payment. You will make money through maybe selling the asset. So for example, you bought it at 100 Rand, and now selling it at 120. So that's how you make your money as well. And then obviously the interest. And then for equity, your main money is going to come through dividends. Alternatively, it will also be through capital gains when you sell it. So you buy for 100 Rand, you sell it for 50 Rand. So that's just basically in terms of how it works in the real world. Once we know what's happening in the real world, now we ask ourselves how to do the accounting treatment. So remember, the accounting treatment is dependent upon what's happening in the real world. Does that answer your question? I don't know if I missed your question or if I understood your question.
No, it's clear. It's fine. It's okay. Fine.
Okay. Any other questions?
Yes, Faiz.
Yeah.
I wanted to ask with regards to intention of management versus business model.
Yes.
Are there instances where the intention of management might be not in tandem with the business model? Are there any cases like that?
Like I think people will do that only for to get away with an accounting treatment. But what you'd have to look at the circumstances. So that's what the auditor will do. So an auditor will have a look. Okay, you are saying your business model is to hold contractual cash flows. But what is actually happening? And auditors will have a look at. So that's like part of the job of auditors to make sure that what you say the thing is and what's actually happening doesn't match. Like I've been on the side of management. Like, I mean, I'm not the management, but I've been, I know auditors would ask us and we must explain. And but they would say, okay, but you're saying this, but look what's happening there, and things like that. So there can be instances, but that's where the management is going to do what they feel is best, right? The audits will then check. The audits will then confirm whether they agree or not. But yeah, it can be where your intention is different to what's actually happening. But I guess it's got to do with management integrity. So management that have integrity, they wouldn't just play around with it for the sake of playing around. They would actually make sure that the business model and the intention and how it's actually operating are in sync. But I don't think it'll come to an exam situation like that. But in the real world, you can definitely come across stuff like that.
Okay, thanks, Faiz.
All right, Faiz.
Yeah.
Just I think one thing that I think I was trying to put out there was so we said it's an elimination method, right? We started with amortized cost.
Yeah.
Then favor through OCI is mandatory, right? When it resembles some characteristics of amortized cost.
Correct. But the only difference is that it includes the resale of an asset.
Okay. All right. Okay, good.
Okay. Anything else? Desiree, Shayla, Taurai.
Yeah, following.
Marilyn, any questions?
No, nothing yet.
Okay, so then we're fine. So I'm in the next lesson. I'm going for fact. I'm going to do a groups question. Okay, I'm going to do a groups question. But I'm going to send it to you before the time, so you can read the scenario before the time, and we can just jump straight into the question. Obviously, we're going to read the scenario, but I'm not going to spend so much time on reading the scenario. Just try to work through the question. I think Justin sent me a group question, so I will have a look at it and I'll let you guys know. And then please make sure you practice and then see if there's any question that you have. Try to ask it in the group, and then we can try to answer it from in there. If you have, and remember, if you want to do a one-on-one for 15 to 20 minutes, you can set up time with me. But obviously it must be like literally one question. When I say one question, not a 50 marker, that's why I set it to 15, 20 minutes, because it's focused on one specific thing. So we don't go through the entire question, we're just doing one specific thing that you can't get, and we work through resolving that issue. Okay, so you can also do that, but you obviously must have worked through the question and have a specific question you want to ask me, and you obviously have to let me know before the time so I can look through it as well. So I don't sit the whole 15 minutes looking through it while I'm on the call with you. So please practice and then see if there's any specific question that you may have. Okay. Okay, thank you guys. I'll see you guys next week. So we just need to do that other one more makeup class, but I'll tell you when we'll do the makeup. Probably Friday again. Okay.
Oh, so Saturday is now completely off, or
yeah. I was only going to do this tomorrow to make up, but so I'll just make it up again on next week Friday, or Friday coming. Yeah, even next week Friday.
all right. Great. Thank you, Faiz.
Okay, so I just resent. I know some of you watched it already. The financial instruments. I'm looking for the revenue question. I cannot remember if it was. I'm gonna look again, and then it may be one of the tests that I did it. The CTA test week. So I don't see it here on YouTube. So it must be in one of the tests. It's a very good question, similar to what you call it. But that question was basically the first question on the revenue that Psycho tested. And they obviously used a cell phone company, because a cell phone company was one of the big companies in the world that was going to be impacted by the change in revenue. Okay. And it was also much easier for us to understand and much easier to test the principles of revenue for a cell phone company. So when I find it, I'll send it to you, the video. So then just make sure you work through that one, and you work through how can I say, your one, your revenue question is very good. Okay, so with the cycle one, it's testing similar principles. So now you're getting two big questions on revenue, testing almost all 5 steps on a deep level. So you're going to get to learn it quite nicely. So make sure you work through both. So I will try to find it by tomorrow, and then I'll send it to you guys. Okay.
Oh, you have uploaded it on YouTube, right?
Yes, but you're not going to find it because I can't find it. I went through all my stuff, so it's not. So it is uploaded somewhere on YouTube, but it's not called revenue. So I don't see it. I don't see it. So it is probably in the test weeks, one of the test classes. Yeah, but it's somewhere on YouTube. I just need to go through it and find it. Tinashe, you have a question? I see your hand is raised.
No, it's an audio.
Oh, okay. Any other questions?
Is the recording for this lecture going to be uploaded in the folder? on the
Sorry?
Google Drive folder.
Say again?
Is the recording for this session going to be uploaded in the Google folder?
Yes, so
Google
everything
Drive
I'm,
folder.
yeah, everything I'm uploading in the Google Drive folder. So everything up until the second class is in Google Drive folder. This one will be uploaded by tomorrow. Okay.
All right, thank you so much.
Okay, pleasure. Okay, bye-bye guys. Have a good weekend.
All right.
Thank you.
Pleasure. Bye.
Thanks a lot.